If you've been considering a purchase, a move, or a refinance and haven't pulled the trigger, chances are you're waiting to see if mortgage rates are going to come down this year. Well, you're going to want to watch this video because we'll be bringing you helpful research and analysis.
Welcome to Rock Real Estate with Stu Simone, where we make real estate informative and fun. And now, here's your associate broker, real estate attorney, and mortgage loan originator, Stu Simone.
Hello everyone, welcome back to our channel. This is Stu Simone at Rock Real Estate. Today, we're embarking on a journey through the intricate landscape of housing, financing, and interest rates, honing in on the 2024 forecast. Whether you're a homeowner or a professional investor, you're in for a comprehensive analysis. So grab your favorite snack, settle in, and let's see if we can answer the big questions for 2024. Will interest rates come down? And if so, by how much? Well, after reaching a shocking 7.79% in October 2023, mortgage rates have taken a breather, with the average 30-year fixed mortgage rate hovering at 6.6% for the week ending January 11th, according to Freddie Mac. And as almost everyone knows, rates rocketed from the high 2s to the mid 6s in just a couple of months, about a year ago. So a burning question on everyone's mind is, what's causing these fluctuations? And what can we anticipate in the coming months? Factors influencing rates. To truly understand the dynamics behind mortgage rates, it's essential to explore the various factors at play. From broader economic conditions to the Federal Reserve's policy decisions and the backdrop of inflation, a complex interplay of factors shapes interest rates. The Federal Reserve. Obviously, one of the critical players in this economic theater is the Federal Reserve. When the Fed raises or lowers federal funds rate, which is the rate lenders charge one another, it can create a ripple effect resulting in higher or lower mortgage rates. While the Fed doesn't have a direct impact on mortgage rates, it impacts several markets across the globe, and the effects are felt in the mortgage market. The Fed funds rate can be as low as 0, and it affects the bottom line of those offering credit. When the Fed is trying to control inflation, as recently, or cool the market, they start raising this rate in increments over time. When they're trying to spur the economy, they start lowering the Fed funds rate. Recently, inflation has started to cool, a signal that the rate increases over the past few years have worked and are bringing inflation back down. As a result, the Fed's hikes have gotten smaller and less frequent. And in fact, there hasn't been any increases since July of 2023. In the final meeting of 2023, the Federal Open Market Committee, the FOMC, made a pivotal decision to keep the benchmark federal funds rate steady. This marked the third consecutive rate hike pause, maintaining the benchmark interest rate range between 5.25 and 5.5%. This is welcome news, especially since they were hovering close to 8% in October. At the end of 2023, with inflation easing, the Federal Reserve hinted that it would start cutting interest rates in 2024. Projections from the Fed's December meeting forecasted the federal funds rate to fall to 4.6%, down nearly a point from the current rate. Economic health and supply and demand. The overall economy affects mortgage rates. When the gross domestic product, the GDP, and employment rise, it's a sign of a growing economy. So there's a greater demand for goods and services, including real estate. A growing economy creates competition from those wishing to borrow money. This demand causes interest rates to rise, and the opposite is true in a slowing economy. When demand falls, interest rates tend to go down. In terms of home loans, the supply is the money or credit available to lend. A high demand for mortgages means banks have less money to lend. Therefore, the cost of a loan goes up via higher interest rates. This also means that when there is more money to lend or an increase in the supply of credit, the cost of borrowing goes down in the form of reduced interest rates. Another factor is how other debts impact a bank's ability to lend money. For example, a missed credit card payment or mortgage payment will reduce the amount of credit available in the market. When the credit supply tightens, that creates higher interest rates. Inflation. Everyone is affected by inflation. You, your mom, your dry cleaner, and even your bank. Inflation occurs when the money supply used to purchase products exceeds the products available for purchase. The bigger the gap, the higher the inflation. Put another way, a high rate of inflation means your dollar doesn't go as far. You have to do more with less. Higher inflation will typically cause treasury yields and mortgage rates to rise as well. This occurs because investors demand higher rates as compensation for the decrease in purchasing power of the money they are paid over the course of the loan. And as I stated in my video way back at the beginning of 2023, raising interest rates is one of the few ways that the government can slow inflation and prevent it from getting even worse. Your credit score. Now let's not forget factors that affect the rate that you would pay on your mortgage. Not surprisingly, mortgage lenders want to feel confident that you will pay your money back. They're willing to trade a lower interest rate for this peace of mind. Though every lender and loan program is different, borrowers with a credit score above 720 typically qualify for the best interest rate offers. Having a strong credit history, one that includes a lengthy track record of consistently paying bills in a timely manner and maintaining low balances on lines of credit, drives your credit score upwards. This is generally the type of profile prospective lenders like to see. Before applying for a mortgage, it's a good idea to check your credit score and do what you can to improve it if there are any areas of concern. If you still have some time before you need to apply for a mortgage, actively work on boosting your credit score. Don't forget that every American can go to annualcreditreport.com for free once every year. If you see anything negative that is an error or questionable, you should challenge it, and then that negative reporting is automatically taken off your credit score for 30 days. You might be able to remove the negative event permanently if you can prove to your lender or your creditor that is an error. Your loan-to-value ratio. Yet another consideration for lenders when developing interest rate offers is the loan-to-value ratio, the LTV, of the property you're purchasing or refinancing. This is simply a comparison between the amount of the loan you're seeking and the current fair market value of the property. So borrowers who have a larger down payment for their home purchase lowers the amount to be borrowed and thus have a lower LTV. And these buyers tend to be a lower risk to the lender. Predictions from experts. Now let's tap into the wisdom of experts. Bess Friedman, CEO at real estate company Brown Harris Stevens, observes that mortgage rates are already in a better place than they were in the fourth quarter of 2023. The average 30-year rate is around 6.5% again, which is welcome news, especially since they were hovering close to 8% in October. That's what she says. But to some, that late 2023 decrease means that mortgage rates don't have much more room to fall in 2024. Michael Gevett, CEO of Bluebird Lending, says, I don't think rates will fall much more for most of 2024. We had a steep decline at the end of last year, which will probably make it stable from this point forward. Others, however, expect rates to decline even more. Based on what the Fed has indicated, Jeff Lichtenstein, founder of Ecofine Properties, expect mortgage rates to fall slightly this year as the Fed cuts rates. He says for 30-year fixed-rate mortgages, the target that we see is approximately 5.5%, he says. On the flip side, Lawrence Yun from the National Association of Realtors is cautious, predicting rates staying around the 7% mark. Refinancing opportunities in 2024. If you purchased real estate in the last year or so, the odds are good that you ended up with a higher mortgage rate and monthly payment than you like. Refinancing has become a buzzword so far this year, especially with a tantalizing prospect of Fed rate cuts in 2024. The Mortgage Bankers Association is boldly forecasting a 56% jump in refinance volume this year. Just remember, the rates we saw during the height of COVID-19 in 2020 and 21 were historically low, and many say we will never see them again. So, don't get too excited thinking that you may be able to swap a 7.5 mortgage rate for a 3% one in 2024. A Fannie Mae's December housing forecast predicted rates as low as 6.5% by the end of 2024. The Mortgage Banker Association's mortgage finance forecast from December calls for 6.1% at the end of 2024. And the National Association of Realtors Quarter 4 2023 Economic Outlook predicts 6.3% to close out 2024. So if your current mortgage is in the 7s and or you want to grab some cash from the equity of your property and or you just want to lower your monthly payment, a refinance should be worth considering this year. Long-term vision. Peering beyond the horizon of 2024, industry experts are painting a picture of declining mortgage rates. though probably not revisiting the historic lows of 2020 and 21. The timeline for this downward trend remains a subject of speculation, but some industry pundits predict rates could be at least 2% lower by 2025. While predicting mortgage rates for the next 5 years is a challenging task, to say the least, especially given the unprecedented fluctuations of the past year, experts suggesting that the low housing inventory will play a pivotal role in determining future rates. Of course, the farther ahead your prediction, the greater the chance it could be wrong. At least we can say we are hearing very few voices that believe rates will rise or even remain flat, so that's good. Strategic approaches for optimal rates. Now that we've traversed through the complexities of the 2024 interest rate landscape, let's explore actionable tips to help you secure the best possible mortgage rate. Whether you're a first-time homebuyer embarking upon this exciting journey or contemplating a refinance to seize potential cost savings, stay tuned for valuable insights that could save you a substantial amount over the life of your loan, if you smartly time your purchase or refinance. Number 1, monitor Federal Reserve announcements. Keep a close eye on the Federal Reserve's decisions and announcements, as they play a crucial role in influencing mortgage rates. Understand how changes in the benchmark federal funds rate may impact long-term interest rates. Regularly check for updates from the Federal Open Market Committee, the FOMC, to stay informed about potential shifts in monetary policy. 2, stay informed on expert predictions. Stay informed about expert predictions from reputable sources like Realtor.com and the National Association of Realtors. You can utilize this information to gauge the potential trajectory of mortgage rates in 2024. And check here too, of course. Regularly follow insights from industry experts to make informed decisions about when to lock in rates or explore refinancing opportunities based on your individual circumstances. Number 3, explore refinancing opportunities now. Considering the buzz around potential Fed rate cuts and the Mortgage Bankers Association's forecast of a significant increase in refinance volume, explore refinancing opportunities this year. Evaluate your current mortgage rate against the prevailing rates and assess the potential benefits of refinancing to lower your monthly costs. Actively engage with lenders to understand the refinancing process and associated costs. That would include me. Number 4, long-term planning for homebuyers. If you're in the market for a home, consider the long-term vision painted by industry experts. While rates may decline beyond 2024, strategic planning is crucial. Assess your financial readiness, explore pre-approval options, and keep an eye on market trends. Being prepared for potential rate changes in the coming years can help you make informed decisions about the timing of your home purchase or refinance. 5, understand economic influencers. Gain a comprehensive understanding of the economic factors influencing mortgage rates. Educate yourself on broader economic conditions, Federal Reserve policies, and the impact of inflation. This knowledge will empower you to anticipate potential changes in interest rates and make proactive decisions, whether you're a first-time home buyer or contemplating a refinance. By following these actionable tips, you can navigate the dynamic landscape of 2024 mortgage rates more effectively, making informed decisions that align with your financial goals. And there you have it, a comprehensive exploration of the 2024 interest rate forecast and its multifaceted implications. We learned that a complex set of factors impacts mortgage interest rates. Broader economic conditions, the monetary actions of the Fed, and the ever-present specter of inflation all contribute to the ebb and flow of mortgage rates. But we also learned that if you keep track of these things, you will maximize your chances to get the lowest possible rate. And don't forget, there are things you can do to lower the rate for your particular transaction. For example, you might want to watch our video on rate buy downs entitled Rates Too High, which explains how you can buy down your mortgage rate significantly to lower your monthly payment. So if you found this information enlightening, please don't forget to give us a thumbs up, subscribe for more in-depth financial insights, and share your thoughts in the comments below. Stay tuned for more updates as we navigate the ever-evolving landscape of real estate finance. Remember, Rock Real Estate is all about maximizing your most important asset, your real estate. So until next time, stay informed, make your decisions based on research, and they will be wise ones.